Welcome back. We are in segment 2.3 and in this segment we'll be discussing about the dual aspect concept. Please recall that we in the previous segment we have in segment 2.2 we have started discussion on accounting concepts. We mentioned that there are many accounting concepts and out of those we have identified 5 concepts which are of relevance to our discussion. In the previous segment we have discussed about the money measurement concept, business entity concept and the concept of conservatism. In this segment we will be discussing exclusively a very important concept called as a dual aspect concept. Right? Dual aspect concept is actually the backbone of double entry bookkeeping. Accounting worldwide is based on a entry method known as double entry bookkeeping. Right? Accounting is basically bookkeeping. Right? Accounting and bookkeeping, the terms are synonymous. That's what we do in accounts. It is what you do with those accounts forms the basis of another subject called financial management or the financial analysis. What you do with those numbers, how you interpret is another subject. But the basic subject of bookkeeping is nothing but accounting. And accounting is done in a process known as double entry bookkeeping worldwide. This is the process. And this is this concept which we are going to discuss, the dual aspect concept, is the backbone of double entry bookkeeping. So what this concept simply says is every transaction has two sides to it. If you want to put it in simple terms, that is what dual aspect is all about. So every transaction has two sides to it. So as you are aware, in your bank you might have come across various departments, like so you have credit, you have risk management, you have CMRD, you might have staff department, and all these departments, various departments. So you are used to functions of a bank departmentalized, into various may I call silos, into different silos. So each one of you employees gets into one silo, a particular silo, right? So all employees are classified into one particular department. When it comes to accounting, right? Similarly, you can think of every transaction as being dumped into one silo, right? For example, if you have, let's say, a company has paid salaries for the month of April. So this is a simple transaction. So if I were to ask you, please dump it into any of the functionalities. So you put straightly say salaries. You will create a new function called salaries, and in it you will dump this figure. So if this figure is 10,000, you will dump those 10,000 into this particular silo, right? Similarly, take for example another example where the company has purchased raw material. So maybe there is another box called raw material. You will dump that amount into raw material. So from a plain English point of view, every transaction, any financial transaction, you can identify one particular function and in which you can dump the figures. But what the principle of double entry bookkeeping is, it says that every transaction has two sides to it. From now on, you have to remember this point, that every transaction which you come across that gets in the books of account will have two sides to it, right? So if you take salaries, right? So salaries will be the same amount. Take for example, salaries is 10 lakhs, right? So this 10 lakhs goes into two particular heads. We'll discuss what these heads are. For the moment, just remember that every transaction goes into two separate heads, right? This is head 1 and head 2. So salaries has gone into two heads. Similarly, the company has purchased raw material. Even that goes into two separate heads. It cannot be these two same heads. It can be these two same heads, or one of the heads may be common. The material it was right now, right? For the moment, remember that every transaction goes into two separate heads. Similarly, the company has made a sale and it has received income. Again, goes into two separate heads. Finally, you can take another example where the company has given festival advance to staff. So it also goes into two separate heads, right? So what the double entry bookkeeping says is every transaction will be having two effects. One is a positive effect, another is a negative effect, or it can be two positive, two negative, right? We will discuss what the effect is shortly, but two heads will be accounted by every transaction. Hence the name double entry keeping. Then some magic happens, right? Some magic happens. I'll tell you what this magic is. But because of that magic, you know what happens? If you were to draw the balance sheet, see all one side, we already discussed that every transaction has two sides. So one side miraculously gets dumped into one side of the balance sheet, right? And the other side miraculously jumps into the other side, and hence balance sheet tallies, right? For example, let us say this is 5 lakhs, this is 2 lakhs, and this is 1 lakh. This is 2, 1, 5 lakhs and 10 lakhs. What happens by this strange process, this 10 comes to this side, this 5 comes to this side, another 2 comes here, another 1 comes here. Similarly, the other transaction, note that these two amounts are same, right? The 10 lakhs affects two heads in the same amounts. So 10 lakhs, 10 lakhs. So one head gets into 10 lakhs, the other head comes here. So 10, 2, 5, 1. So your balance sheet gets tallied. The beauty of double entry bookkeeping is the balance sheet always tallies. Right? How it tallies is something which we will discuss in detail, but this is the crux of double entry bookkeeping. Every transaction affects two heads, and by some strange magic, all of them gets affected in diverse opposite ways. You can think of it as plus or minus. You can, if you want to think about in advanced terms, in true accounting terms, it affects debit and credit in opposing ways. Finally, the balance sheet gets tallied, right? This is the crux of the double entry bookkeeping, right? So having seen the broad picture, the overall picture of the dual aspect concept, let us get into the basics. So let us take the example where you as a proprietor have started your own business called Akash Tablets. Okay, you have started your own business, a proprietary firm by name Akash Tablets, which manufactures tablets, okay, the computer tablets. Into this business you have invested your own money, right, of 1 lakh. You invested your own money into 1 lakh to start the business. Please recall our discussion in the earlier segment where we discussed the business entity concept, where we said the owner and the business, two different entities, right? So even if the owner is in practical terms nothing but the business, right, both are one and the same, but from the point of view of accounting, we segregate them and we treat owner as just another outside party from which the company has borrowed funds. So the company has borrowed funds from many sources, from banks, say from chit funds it has borrowed some money, from creditors, from bank term lenders, working capital. This is working capital, this is term lender. So owner is also an outside party from which the company has borrowed funds. So we treat the owner as a separate entity from the company, right? So against that background, this company Akash Tablet, you have invested 1 lakh into the business. So the business has taken a loan of 1 lakh, right, from the owner, and we give this fund a special name, as we already discussed, known as capital. So when we speak of the double entry bookkeeping, in this particular example, two heads that are affected. So from now on we'll discuss two heads for every transaction. So in this particular example, when you have invested 1 lakh into the company, there is something called capital, we already discussed. So capital will be affected by 1 lakh. So if you want to name the headings, it is actually liabilities and assets. Okay, this is the liability column and this is the asset column. But since we have not discussed in depth what is liability and asset, let us rename them sources and uses. Okay, so for a short period of time, till we are actually comfortable with the terms as liabilities and assets, we'll name these two columns as sources and uses. And under the sources column, we'll be listing all income or all funds from which we have obtained the funds. Like the sources could be proprietor himself, it can be banks, it can be any outside parties from which the business has obtained funds. So it will be a liability in the sense that company has to pay back this amount one day. So that is what liability is, isn't it? When you speak of liability in normal terminology, what is liability? Liability is a negative thing, right? You owe somebody something, so you have borrowed something and you have to repay them. So from the business point of view, sources are funds which the company has borrowed from outside parties and it has to repay them, and hence is the liability, right? So these sources can be any entity from which the business has borrowed funds. So for the moment we have only capital, but in future the company can borrow funds from banks, so it becomes a liability. The company can borrow funds from creditors, it becomes a liability. So any entity from which the business borrows in future will be clubbing it under the sources column, right? And under the uses column will be mentioning what we did with that money, right? Is the use, to what use have we put those funds? So okay, you got the total, say 10 lakhs from all sources, from capital, banking, you got 10 lakhs. So what did you do with this 10 lakhs? You place a bank fixed deposit in 10 lakhs. Straight away you went to the bank and opened a fixed deposit and dumped the 10 lakhs into the fixed deposit. Or did you buy a machinery 10 lakhs? So what did you do with that? So we'll list the uses in the right hand side column, right? So in business parlance, this is known as asset. This is an asset because, right, think about asset from your point of view. As an individual, what is an asset for you? Gold is an asset for you. Your house is an asset. Your vehicle is an asset. What is an asset? Asset is something which you can sell. It belongs to you and you can sell it so that you can realize money, right? So from business point of view also, these are all assets. Machinery is an asset, land is an asset, building is an asset, right? Fixed deposit in the sense that you can convert that into cash, so that is also an asset, right? So any item which can be translated into cash is an asset. So from here on in, we'll be discussing two columns and we'll put every transaction we'll see what are the two heads that are affected, right? So in this particular example, Akash Tablets, the proprietor has invested 1 lakh into the firm in the form of capital. So when you speak of sources and assets, Akash Tablet has, we can say, obtained a loan from the proprietor. So we'll say capital. So it is a source of fund. It's a capital. So one head that is affected, one accounting head that is affected due to this transaction is the capital account. So what has happened due to this? So how did the proprietor bring money into the business? It was in the form of, was it in the form of some asset, some land? Did he bring some machinery directly, or was it through shares? So in what form did the business owner bring funds into the company? So here we can say the proprietor has pumped in cash. Okay, so the proprietor has bought cash, 1 lakh cash is pumped into the business. So cash is an asset. We already discussed. Of all the forms of asset, in fact, cash is the number one asset, because we defined asset as any entity that can be converted into cash, right? Like a land or building or any asset that can be converted into cash. Cash itself is an asset, right? This is the supreme form of asset. So in this particular transaction, I want you to know that there are two accounting heads that are affected. One, by the proprietor by having brought in his own funds of 1 lakh into the business, has affected two different accounting heads. One is the capital head, another is the cash head, right? So that is transaction number one. So this is what you can see here. So one is the liability we discussed. There is the firm now has at its disposal cash of 1 lakh, right? So with this cash, it can do a number of things. It can buy raw material, it can pay power bill, it can pay advance to suppliers, whatever it can be. So this is an asset because it can be put to use, right? As of now, it is a form of cash, but in future we'll see this will be converted into any other item. So I want you to be clear about the balance sheet at this point of time. Remember, balance sheet is an advanced concept for you right now. Simply, I'll be putting it in this format, very simple format, where I'll draw a table. In the left side, we have sources, and the right side, we'll have assets. See how the balance sheet looks at this stage. At the stage of end of the stage, where we have where the proprietor has pumped in a capital of 1 lakh. How does the balance sheet look like? So this is how the balance sheet looks like. See, this is how the balance sheet looks like. So liabilities of the firm, which we already clarified as from whom the firm has obtained money, and assets we have clarified as where the firm has put the money into use, right? So if you put the above transaction in this format, you'll have capital, owner's initial investment. This is also called capital or equity, right? 1 lakh goes here, and the opposing side you have cash of 1 lakh. And please remember that the balance sheet always tallies. In fact, the backbone of double entry bookkeeping, which we have discussed, the dual aspect concepts, always ensures that the balance sheet tallies. We'll be discussing many transactions from now on, but at each and every stage of the transaction, you can check that balance sheet always tallies. In fact, the double entry bookkeeping is designed in such a way that the balance sheet is always tallies, because the amount is not changing. The same amount goes into two separate heads, and that's why balance sheet always tallies. We'll see another example. Let us take a second transaction where start the firm, you have taken a factory shed on lease, right? So factory shed on lease, and for this you are required to pay 5 months rent as refundable deposit. Refundable in the sense that the money will be paid back to you, right? So 25,000 lease deposit is to be paid as a refundable deposit, right? So think about this transaction for a moment. So when you're saying we have to pay 25,000, so in what form will the landlord accept the payment? So obviously it's in the form of cash. You can't say I produce steel, so please take this steel worth 25,000 and accept it in the form of deposit. He doesn't take it, right? So he wants cash. So obviously through this transaction, one accounting head that is going to be affected is the cash head. Does the cash increase or decrease? Obviously decrease, because you earlier had cash of 1 lakh. So you have to pay 25,000 as refundable deposit. So the cash goes down by 25,000. So your cash will now be 75,000. What is the other head that is affected? Right? We spoke of the dual aspect affecting simultaneously two different heads. In this transaction, of course, cash is affected. It has gone down from 1 lakh to 75,000. So that is one effect. So what is the other effect? Like, just remember that this is a deposit, right? So what is a deposit? Refundable deposit, right? This is deposit in the sense that you'll get back this amount one day, right? Which means it will be converted into cash one day. I know it's not something which you'll get it tomorrow, because once you occupy the factory shed, it's a long-term process, right? You'll be there for 10 years or 20 years. But from the point of view of the business, this money is going to be refunded to you someday. Say for example, the business has wound up. Now it's making losses, we've closed down. We'll return the factory, the land, the shed to the landlord. Then we'll get back the deposit. So this deposit is an asset to the company. Just as gold, just as property, land building is an asset to an individual. For this company, this 25,000 is an asset in the sense that it will get back one day in the future. Maybe not today, maybe not tomorrow, definitely it will come back someday. So for the business, it is an asset. I have to create another head. Let us call this deposit. So this deposit will be an amount of 25,000, right? So in this transaction, we have again seen that two heads are affected through the same amount. So earlier we have seen one is the liability side and the asset side being affected by the same amount. So when we spoke of the first transaction, the proprietor has invested 1 lakh into the business as capital. So 1 lakh went to the left side, 1 lakh went to the right side. So balance sheet has tallied. So balance sheet 1 lakh total has tallied. In this example, you have to understand that there is another way in which the balance sheet can tally. One side need not be affected at all. So in this example, the liability side was not affected. See this example of 25,000 lease deposit. The liability side was not affected. In fact, the two heads that were affected, both cash and deposit, are on the asset side. So this is another type of transaction that you need to understand. You'll have transactions where either both liability and assets go up by the same amount, as in the first example. So both has gone up by 1 lakh, and the balance sheet tallies, because both amounts, see earlier before this transaction, let us say the balance sheet, total of the balance sheet is 5 lakhs. So once the proprietor has brought in funds, well, this should be actually the first entry. So you won't have 5 lakhs before, but for example, for a discussion, let us assume that already there is a 5 lakh total in the balance sheet. By nature of this 1 lakh investment, balance sheet goes up 1 lakh on both sides. So 6 balance sheet tallies. But in this example, you should understand there is another way in which the balance sheet can be affected. The liabilities need not be affected at all, or the assets need not be affected at all. So one side will remain as it is, and the other side, in two different heads, one will go up, one will go down. As in this example, here we have the cash going down and the deposit going up. So before this transaction, we have already seen that the total balance sheet is 1 lakh, capital entry 1 lakh, cash is 1 lakh, capital is 1 lakh. Now after the second entry, liabilities is remaining same, right? And cash is making a downward entry of 25,000 and deposits making 25. So these cancel each other and the balance sheet still remain 1 lakh. So the balance sheet is still tallying after the second transaction, even though two entries in the same side are being affected. Entries are not going up simultaneously. So one has gone up and one has come down. So balance sheet is tallying, right? So this is a second transaction. You need to be aware of these two types of transactions. Either both sides are affected, or in the same head, one goes up, one goes down, right? So balance sheet always tallies. As we already discussed, please note that, please be clear why this is an asset, this deposit, right? This deposit is an asset because it will be converted into cash. It will be coming back to the business one day, and hence it is an asset. This is not in the cash form right now. So many items in the business are not in the cash form right now, like stocks, your raw material in go down. It is an asset to you, right? Just as gold is an asset to you as an individual, for a company, raw material is equal to gold. It will sell tomorrow. It will convert this into finished product and sell it and realize cash. So this is an asset. What is an asset? An asset is an item that can be converted into cash one day. So that is an asset. Or if you pay the amount but you are yet to receive the service, that is also an asset, isn't it? If you paid the amount but you get yet to receive the service. For example, if you have this insurance, you pay insurance for machinery or insurance for stock in a godown. So whatever insurance you pay, the normal process is they will take insurance for the whole year. So you're in, say for example, in March, the policy is due. So you go to the insurance company and renew the policy. So they'll give to April to March. This is 2013. So 2013 April to 2014 March they will renew the policy. You're now in March 2013, but the policy is valid for the next 1 year. So you already paid the insurance premium, and you'll be entitled to the service of the insurance company for the next 1 year, even though you're in April or May or June. For the next coming 12 months, you already paid the insurance. So it is an asset because you will receive the service in the future for which you need not pay then. For example, the machinery has broke down somewhere in September. In September, the machinery is broke down, right? So the machinery is broke down. The insurance company is liable to reimburse you, say 10 crores. So huge machinery is liable to pay. You need not pay any amount, the premium then. You already paid in March itself. So you'll be receiving the service of the company, the insurance company, in September, and then you need not make any payment because you already made the payment. So as on March 2013, this is an asset to you because you already paid the amount and yet to receive the service. So asset can be in two ways. One, and if an item can be converted, is a physical asset, the physical tangible property that has been converted into cash at some point, like machinery, land, building, stock, whatever it is. Physical it's services which we have paid the amount but yet to receive the service, right? So we'll go to the next example, next transaction, and in this transaction, before you go to the transaction, you can review what's happened in the two transactions so far. We have the liabilities 1 lakh. And the second transaction, cash has come down by 25,000 and deposit has gone up by 25,000. The balance sheet is tallying, right? This is the end of the second transaction. Let us take another transaction. This is the third transaction where the business is now requiring some machinery to be purchased. Okay, you now need to purchase some machinery. So the machinery cost is 1,25,000. So think of yourself as the proprietor. You have machinery to be purchased of 1,25,000, but you have cash of only 75,000. So what do you have to do? Either you have to bring in your own funds of 50,000. With that 50,000 and with this cash of 75,000, you can buy the machinery, or you have to borrow this 50,000. Let us assume that the company has borrowed from the bank 50,000. This is a loan of 50,000. So when we speak of a borrowing, is it a liability or an asset, right? So forget the terms liabilities and asset right now. I've already told you. Is it a source or is it a use? So the bank loan is a source. You have taken loan, so it's a source. What is a source? The bank. So it's a liability in the sense that you have to pay back the amount to the bank one day. Just as you have borrowed 1 lakh, the business has borrowed 1 lakh from the proprietor and it has to pay back this amount to the owner one day. It has to pay back 50,000 to the bank someday. So it's a liability. It's a source of fund which will be dumping it in the left side column, right? So one head that will be affected through this transaction is the bank account, right? So bank account will goes up by 50,000. So this will be 50,000. So total will be 1 lakh 50,000, 1.5 lakhs, right? What is the other head that is affected? It's not going to sit idle. It's not like that 50,000 will come and sit in the cash account. So there's a purpose to this 50,000. It has to go into the machinery. So you're going to buy machinery with this 50,000. At no point of time will the bank loan be in the form of cash in your hand. Bank will never give you cash of 75,000. Cash of 50,000. So it will be in the form of machinery. So what it will do? It will ask you to put in your margin, right? So say you have put in a margin of 75,000. It says you bring in your margin of 75,000, and then the bank will release its share of 50,000. Together for this 1.25 lakhs, it will issue a DD in the name of the supplier, machinery supplier. So now you have a machinery arriving at your company site. So at no stage you are laying hands on the physical cash. The end result is you're having a machinery in your site, right? So this is the end result. So now you have a machinery, a physical asset in your premises. So if you want to see the net effect of this transaction, the two heads that are affected are, one is the machinery account, another is the bank loan account. Please note that these two amounts are not the same. Loan is only 50,000, machinery is 1.25 lakhs. So what is the balance 75,000? It is your contribution. So how do you pay for it? Cash. The cash balance which you had earlier will now become zero. So physically it's not happening, okay, but that's what happens, right? The bank takes the margin from your current account, so it goes out. So it gives it its share of 50,000. Together the deed is issued for 1.25 lakhs. But essentially this is what happens. The cash becomes nil. You don't have now any cash balance in your current account, right? So it becomes 75,000 becomes zero. So cash is zero. That 75,000 is converted. It is not disappearing. It is converting into the form of machinery, right? So now a new entry comes, machinery 1.25 lakhs. Of this 1.25 lakhs, 50,000 belongs to the bank and 75,000 is contributed by you. So please observe how the 75,000 has transformed into machinery. Cash is not disappearing, right? even though the entry shows 0, it's not disappearing. It is converting the form from cash. It is changing into the form of a machinery, right? So this is something which you'll observe very frequently in the course of business. You will see cash converting like mad. It will be converted into all sorts of form. Take for example, you have purchased raw material. So what happens to the stock? You go into it goes into production shop, and there you'll be applying some process, and finally you have the finished goods. So how do you purchase? Take for example, this is a cash purchase. So you earlier had a cash of 1 lakh, now it becomes 0. So because with this cash you have purchased raw material. Now the raw material is converted into work in progress. So it is in the process of production shop. Then it goes into finished goods, right? So where is this cash? No, this cash is not disappeared. It's not lost. It is converted in the form of finished goods. Now earlier you bought steel, raw steel, like steel bars. Now if you had a finished product, some steel ingot, some product you have. So the cash has converted into a steel ingot, right? So it didn't disappear. It changed form from a physical cash to some asset through which you can realize you can sell it and obtain cash. So this is the process you'll observe frequently. Cash keeps changing from one form to another, and in this example we have seen that, right? So the cash of 75,000 appears to have disappeared and become 0, but a new asset is created, of course along with the bank loan of 50,000, right? And together the cash has appeared to be becoming 0, though it has not actually become 0. It's only changed form. So in this particular transaction, what are two heads? In fact, there are 3 heads that are affected. The 3 heads are machinery account, bank loan account, and cash account. So this 1.25 has 2 components, right? 75,000 cash term and 50,000 bank loan, right? So if we were to draw the balance sheet at this stage, this is what the balance sheet looks like. We have a new entry called bank loan. Earlier we had the capital of 1 lakh. So business has borrowed funds totaling 1.5 lakhs from 2 parties. One is the owner and another is the bank. So total 1.5 lakhs borrowing the company has done. And what it has done with this 1.5 lakh? Bought machinery 1.25 lakhs. Another 25,000 is in the form of a lease deposit. So balance sheet is tallying, right? Even at the end of the third transaction, we have seen the balance sheet tallying. Let us take another transaction. Here, the landlord who has taken lease deposit tells the owner that as a policy he gives interest on the deposit. So he now decides to give an interest of 1,000, right? So this is a fresh transaction, and now it is to be entered in the books. So any idea what are the 2 heads that will be affected, right? The landlord is now giving interest of 1,000. So how does he give 1,000? He comes in the form of cash. He hands over cash of 1,000, right, to you. So you can physically see. So 2 500 rupees notes. Physically you can see. So this is a cash. So the asset in the form of cash, this 1,000 goes up. So what is the other head that is affected through this? Well, it might not be apparent to you right now, but I'll tell you what it happens. So who gets this 1,000? Who gets this 1,000? In the sense that to whom does this 1,000 belong? Really, it belongs to the owner of the business, isn't it? So the interest on the deposit, who paid this deposit? The landlord, the business owner has paid the deposit, right? So this deposit the interest actually goes to the owner. You can say since we are segregating owner and business as separate, this 1,000 should go to the company. That's correct. You're absolutely. This 1,000 should go to the company, right? But do we have a separate entry where the profit? This is a profit, right? This 1,000 in the sense that you have made an investment of 25,000. Think of it as an investment. This is a refundable deposit, but think of it as an investment. You have invested 25,000 in the mutual fund or share market, and now you're getting dividend. So where did this go? This is a profit to the company. So there should be some entry where it goes, right? And it is a source, right? So to whom do you pay it? Ultimately, to whom all the profit goes? So all the profit of the business ultimately goes to the owner. So what we do is, let us have a entry. Let us call it reserves and surplus. So in reserves and surplus, there have many items like all your profit in the P&L account comes here. The surplus in P&L account comes into the reserves and surplus. You have something called general reserve. You have something called capital reserve. So whatever it is, let us have an entry called reserves and surplus into which all the profit goes. So what I am telling here is this 1,000 belongs to the owner because all profit goes to the owner. This 1 lakh now becomes 1 lakh 1000. Think of it the other way. Take for example, this business has done very badly, and this business has done very badly, and the company has incurred a loss, right? This company has incurred a loss of 50,000 for this year. So who bears this loss? So cash has gone down by 50,000, right? So this is zero right now. Let us assume that it's 50,000. It's gone down by 50,000. So who bears this loss, right? So who bears this loss? Or take for example, the machinery is damaged. You know, some earthquake has come and the machinery is damaged. Now it is worth only 75,000. So this 50,000 reduction in the value of the business. So who bears this loss? Let us assume that it is not covered by insurance. So who bears the loss of the business? So can you go to the bank and say, see, the machinery has gone down by value 50,000. I will not pay 50,000. You can't do that. Take for example, there is a chit borrowing. The company has borrowed from some chit fund 1 lakh. Can you go to the chit fund and say 50,000? Please bear the loss. No. So who bears the loss? Owner. Whatever happens to the business, the owner is ultimately entitled to bear all the losses. So if the loss of 50,000, the capital, even though it appears to be 1 lakh, in effect it comes down to 50,000. You can say the owner has actually invested only 50,000 into the business. Even though initially he's invested 1 lakh, now in effect, after netting this 50,000 loss, we can say the owner's investment, the true investment of the owner in the business is only 50,000. You can say that. You are entitled to say that, because the owner has to bear all the losses. In the similar sense, all profit goes to the owner. There's nothing wrong in it. So this 1,000 which the landlord is giving belongs to the owner. So what we will say is, all profit, dump it into the owner's head. So the capital goes up by 1 lakh 1,000, even though the capital doesn't go in the true sense. We have another item called reserves and surplus that is not relevant to us at this point of time, but please remember that all profit goes to the owner. So this 1,000 goes to the owner. So we'll have two heads that are affected. One is the cash. This 1,000, because of this 1,000 transaction, cash is coming to the business, so cash is affected. So cash will go by 1,000, and the owner's capital also goes up by 1,000. So the company is now liable to pay to the owner additional 1,000. Please remember that the company has borrowed funds from the owner, so the company is now liable to pay 1 lakh 1,000 to the owner, right? So if you see the balance sheet at this point of time, this is how the balance sheet looks like. Is it clear? 1 lakh 1,000, 1,000 the cash, right? Nothing wrong in it, right? So at this point of time, I would like to tell you one important point regarding the income and expenses. Let us talk about income and expenses. Since we discussed in the earlier transaction interest on lease deposit, so we said the income goes into the all profit goes to the owner, and all losses have to be borne by the owner. So let us have a small discussion on this. There are two ways in which you can over this income and expenses from an accounting point of view. So please make a distinction. This is a separate statement, P&L account, and this is balance sheet is here where you have all the liabilities and assets. Liabilities are all the sources of fund, and assets are all the uses to which you put the sources. Now there are many transactions which a company goes through. For example, there is a sale, right? Take for example, a company is engaged in trading, right? It's not into manufacturing, it's only trading. So it buys some good and sells it for a profit. No processing, right? Zero processing. So take for example, it has bought a TV. This company is into the trading of television sets. So it's bought a TV for 20,000 and it is selling for 25,000. So 5,000 is the profit, right? This is what the business of the company is. So if you see the income, it will be 25,000. The expense is 20,000. Let us assume the other expenses like selling, commission and all this are 2,000. So this is 22,000, this is 25,000. So this is 3,000 profit. So what I am saying is, there are two ways in which you can treat this particular transaction. One, you can go ahead and as in the previous example, as in the case of the interest on lease deposit, you can go and dump this income into the owner, because all income has to, in the sense all profit has to be borne by the owner. So you can dump this 25,000 here and dump this 20,000 here, minus 20, because all losses has to be borne by the owner. So this expense has to go here, minus 2 also go here. So net effect of 3. So you can say we'll add the 3,000 here. 1 lakh 1,000 becomes 1 lakh 4,000. You can do that. So each and every income item and each and every expense item you can go on adding to the capital account, right? That is one option. Option 1 is where you enter each and every income expense item into the capital account. The other is maintain a separate account called P&L account. This is what you do in actual practice, right? Maintain a separate account where you put all income and expenses into this head. Don't touch the capital account, right? Keep on entering all income expenses in this P&L account, and finally, what is the net figure? Whatever is this profit, transfer this profit, right? Transfer this profit into the owner's capital. In effect, both are same. So what are you doing? This 3,000 you're ultimately transferring into the owner's capital. So this 1,01,000 becomes 1,04,000. Even that is correct, or each and every item you can go on dumping and then the net effect becomes 1,04,000. So either way is correct. But in practice, because that entry, the option which you discussed in the first mode, where every income and expense item is entered into the owner's capital, it is a very lengthy process, and the owner's capital account will be cluttered, and you don't need that. Yeah, why do you need the cluttering? So maintain a separate P&L account in which all income expenses items are summarized, and only the final profit figure gets transferred into the owner's capital in the form of either in the form of owner's capital or reserves and surplus, right? So we have seen 4 transactions, but please observe that at the end of each and every 4 transactions, the balance sheet is tallying. That is the beauty of the double entry bookkeeping. So as the business goes on, you'll see every day a number of transactions keeps happening. This may run into hundreds of thousands every day. If a big company, there's so many sales, a company may be making some thousands in numbers, 1,000 customers it may be servicing every day. So many sales, so many transactions, so many payments it has to make. So it goes on, these payments goes on, these purchases, this sales, it goes on. So, but at each and every transaction, the balance sheet tallies because of the double entry bookkeeping. So this is what you should remember at this stage. At this stage, you have to remember that every transaction has 2 sides to it, and because of the dual aspect, the balance sheet always tallies, right? So let us now take an example. In fact, we'll take a series of examples, 10 examples, and we'll see how each transaction affects 2 heads, right? So let us take the first example, where the owner is infusing 1 lakh capital into the business. So owner has infused 1 lakh capital into the business. This we have already seen earlier. So what are the 2 heads that are affected? If you take the liabilities and asset, capital is one account, right? Because the company is now liable to pay 1 lakh to the capital to the proprietor sometime in the future. It has borrowed funds from the proprietor. So 1 lakh. So capital is one account that is affected. The other account is cash. This we already discussed, right? So capital account under liability head, capital account increases by 1 lakh, and asset head, cash account increases by 1 lakh. Let us take the second example where the owner has withdrawn cash for his personal use. This is not related to the business. He has drawn for his personal use. So please recall segment 2.2 where we discussed the business entity concept, where we said the owner and the business are separate. So the owner, even though he has drawn for his personal use, he cannot say don't make an entry. It is my money. He can't say that. So the accountant goes ahead and enters this transaction in the books of accounts. So what he does, we have the liabilities, we have the assets. So now the owner has already invested 1 lakh. The cash is 1 lakh. Now the owner is saying, give me back 10,000 for my personal use. So what the accountant does? So he'll deduct 10,000. Cash is now coming down by 10,000, isn't it? So cash will now be only 90,000. In the cash draw, earlier it was 1 lakh, now it's only 90,000. So who has to bear this 10,000? The owner's capital goes down by 10,000, because now the company is liable. Say for example, the company is wound up today, the company is closed today. Now the company has, you are saying at the beginning of the business, the company has taken 1 lakh loan from the owner. Now the company is closed. Now how much the company has to pay to the owner? Only 90,000. So we'll now see another transaction. The company has purchased raw material for cash, right? The purchase raw material for cash. So what are the 2 heads that are affected? So since the company has purchased for cash, cash goes down. So what happens to this transaction? Say for example, the company has bought cement for 1 lakh. So by using cash, so cash has gone down. So what has come into the business? So the cash is converted now into cement, right? The cash is converted into cement. So it is an asset, isn't it? We earlier spoke of the fact that gold or land, building, machinery, all are assets because they can be sold and money will be realized. Though you don't do that in the normal course of business, you don't sell machinery, you actually use it for production. But even then, if you want to sell it, you will sell it and get cash. So it is an asset. So similarly, this cement, it will be in the godown right now, but you will be putting it into production, and some product will be emerging and you'll be selling it. So it is an asset. So cash has come down, right? But cement, you can say stock, has gone up by the same amount. So balance sheet is tallying still. So the third transaction, the 2 heads that are affected are, one is the cash, another is the inventory. But please note a star. Can you see a star here? Transaction 3, transaction 4, transaction 5, transaction 6. There will be small modification which I will be doing in the next slide. Please bear with me. It is not actually that inventory that will be affected, but for our purpose right now, Are you clear? I hope this is clear. Why cash goes down? Because you're purchasing from cash, right? You bought cement from cash, so cash goes down. And what has come into the business? Cement has come. So the stock of inventory has gone up. So this is intuitively clear. So keep it aside. In the next slide, I'll make a small modification, right? We'll discuss it when we get there. So transaction 4 says purchase raw material on credit. So what is the difference between transaction 3 and transaction 4? In transaction 3, you have parted with cash. So cash has decreased. But here you're not paying the party right now. You're buying the material on credit. So you're now creating a liability. Material is coming, so stock has increased. You purchase the raw material on credit. So whether you purchase on cash or credit, the material has come to you. So stock has increased and it is an asset. So what is the other head that is affected? This party, let us call this party A. You'll create a separate head for A, and it is a liability. Because you're liable to pay to this company, to this party one day, right? Say for example, he's given 45 days credit. He says, I will deliver the material to you right now, but you pay after 45 days. So the stock has arrived. It's in the form of asset, right? But it is simultaneously created a liability in the sense that after 45 days, you are liable to pay to the company. So even though this is not a source of fund, we spoke of liability as being a source of fund. So who financed, and assets being what did you do with that? In a way, this is also a source of fund, right? See, delayed payment is a source of fund because you are now free of that amount, which you can put to alternative use. So had he insisted on cash, you have parted with that amount right now. So by freeing you for 45 days, he's allowing you to put that amount into other source. So in a sense, it is a source of fund. So that becomes a liability. So again, this transaction is creating two head. One is the stock account goes up on the asset side, and A's account, we will call it as a creditor. We'll discuss it later. But right now, let us assume that the A's head, individual A's head increased, right? So balance sheet is telling both sides, same amount goes up. So transaction 5, goods are sold for cash. So what are the two heads that are affected? When you're selling, you're realizing cash. So cash account is going up. You sold a material, you sold a product. That is example a TV. You sold for 20,000. So the customer has come and bought for cash. So he's paid you cash. So cash has gone up by 20,000. What is that? So what are the two heads that are affected, right, to this transaction? If we can draw the liabilities and assets table. A customer has come, you're in the business of trading of TV. A customer has come, purchased a TV for 20,000 and has paid you cash. So what is the one head that is affected is cash, right? So cash of your business goes up by 20,000. So what is the other head that might be affected? Can you guess? So this company is in the business of television. So it has some stock of TV. So it's in his shop right now, it has 100 TVs. So the customer has bought one TV and it's got 99. So the stock of televisions is decreasing. So the stock, which we already discussed is an asset, is now decreasing by the same amount, by 20,000. This goes up by 20,000, this comes down by 20,000, and the balance sheet is again tallying, right? Let us see another transaction where goods are sold on credit. So again, what is the difference of this transaction and this transaction? Transaction 5 is on cash. So cash has increased and stock has come down. So what is the difference if the sale is on credit? So you're not getting cash right now. So cash is not increasing. So what are you getting? You're giving credit to the customer. So we'll create a new, I'll discuss this item later, but let us say there is an item called debtor, right? Anyway, the stock anyway goes down because the television is going to the customer right now. Stock is going, but cash is not coming. In its place, we are having a customer who is liable to pay to us in future. So you're given a credit period of 30 days, right? So after 30 days, the customer will be paying you back the money. So it is an asset in the sense that you will be getting cash after 30 days. So earlier we spoke of various forms of assets, and we have discussed the basic principle being that land, building, machinery, gold, any investment is an asset in the sense that you will realize cash someday in the future. So debtor, this company, this particular customer, let us call him B. He's an asset to the company because this person will be paying you back money in future. Please recall that earlier we have earlier classified asset into two categories. One is a physical asset. So for this company, TV is a physical asset. But there is another form of asset. You have already provided the service. We have already discussed the example of the insurance premium. You have already paid the premium, and you will get the service for the next 1 year. Here you have already delivered this TV. So you have rendered the service already. but you're not yet received payment. You'll receive the payment in the future, right? So this is also an asset. So there is a head called debtor, right? Of course, the individual B account will be created in the ledger, which we'll discuss later. But let us call him debtor. We can also call him receivable, or debtor or receivable. All items mean the same. So stock account comes down and debtor account goes up. So that is what the effect of the transaction of 6. Transaction 7, loan of 50,000 borrowed from Z. So loan is borrowed, so cash is coming into the business, cash is going up, and there is a liability. There is a loan liability. Why it is a liability? You have to pay. The company is now liable to pay this person a loan. Say for example, this loan is for a period of 3 years. So after 3 years, the business has to pay back that loan. So it is a liability. So liabilities goes up on the one side, and cash is coming to the business. So it is a asset, right? So that is the effect of transaction 7, right? Please remember that. Let us see transaction 7. Loan 50,000 borrowed from Z. Okay. So now cash is coming to the business. So you have borrowed 50,000. So cash is going to the business. So you're now liable to pay to Z, right? This loan is for a period of 3 years. So after 3 years, the business has to pay back 50,000 to Z. So the company has a liability to pay Z 50,000 after 3 years. So there will be a new head called Z under liability. So that will be increased by 50,000, and of course cash will increase by 50,000. So that is the two effects for this transaction 7. Transaction 8, purchase machinery for cash. So since you're purchasing machinery for cash, so cash is going out. Say for example, this machinery is 1 lakh, so cash has gone down by 1 lakh, but machinery is coming in the form. So it's not disappearing, right? Cash is converted into machinery. So cash goes down by 1 lakh, machinery increases by 1 lakh. Balance sheet is tallying, right? That is transaction 8. Transaction 9, bought shares on credit from P. This is nothing but a similar form like purchase machinery for cash. This is, you can say, purchase machinery from P on credit. Both are same, an asset is created, but one is payment through cash. Here it is on credit. So what are the two effects that are in this transaction? Transaction 9, chairs. So this is a furniture account, right? So the furniture account goes up. So what is the other account? There will be a liability now to pay to P on credit. For example, if the credit period is 30 days, after 30 days, the business is liable to pay back P the payment, the amount, right? So this will be a liability. So the two heads that are affected to this transaction are furniture account, that is an asset, and a liability account. Lastly, we have transaction 10, where in transaction 7 you have borrowed 50,000 from Z. So in this transaction 10 we are repaying 20,000. So now at transaction 7, this is how the balance sheet look like. At transaction 7, you have borrowed loan of 50,000. So cash has gone up by 50,000, and we created a new head called Z. Business is liable to pay back 50,000. Now you're repaying 20,000. So Z account comes down by 20,000. So now you are liable to pay only 30,000. So the business is now only liable to pay 30,000. So how did you pay that 20,000? Your cash balance has come down by 20,000. So now your cash is only 30,000, right? So this is the effect of the transaction 10. The two heads that are affected are cash account and the Z account, right? So you can go on, you can have a number of examples, but the concept is same. Please rewind the video and go through these 10 examples once again. You'll get a fair idea what are the heads that are. You're not going to depth, okay? You're not a professional accountant to be doing that, but let's have a basic idea of what are the two heads that are affected in each transaction. Now we have discussed the 3, 4, 5, 6. We have starred these transactions, and we said that even though we mentioned inventory account is affected, we'll have a clarification later. So this is what the clarification is, right? So the clarification is, if you purchase a machinery, or if you purchase a building or any asset, see, these are not for sale. Usually you don't sell them. This will be employed in the production process for years. They'll stay with you. But something like stock, something like raw material, this is something that you plan to sell. You're not here to run it for eternity like a machinery, right? Your purpose is to sell it. So the accounting convention, there is an accounting convention here. The accounting convention is, whenever you purchase goods, because they are not for the purpose of retaining, let us not write an inventory account. Let us don't write it. You can have a machinery account, you can have a land account, you can have a building account, because these are physical assets which are meant to be retained in the business, but don't have an inventory account. So transaction 3, 4, 5, 6 will not affect, right? Will not affect inventory account. So what does it affect? So earlier this is what we did. So purchase raw material for cash. So cash account has decreased and inventory account has increased. This is intuitive. This is what common sense tells us. But from accounting point of view, this is the correct way. This is incorrect. So what is the correct way? Right, cash account decreases, that is right. But there is something called a purchase account. We now have a purchase account. So instead of increasing inventory account, we increase the purchase account. Similarly, in the second transaction, we increase the purchase account. Then there is something called the sales account. Sales account. That's the only difference. The other will be same. See, these two are same. These two are same. These two are same. And these two are same. The only change is the cash is also same. Only change, instead of inventory, will be having the purchase account, the sales account, right? So I hope you got this point very clear. When it pertains to sales and purchases, the asset head, that is the inventory head, is not affected. It is the sales and purchase account that is affected. That is because the purpose of inventory is not for permanent holding. It is for sale, right? So, but if a machinery is purchased, fine. You have the machinery account that is affected. So cash goes down and machinery increases. So cash decreases. Asset account, that is the machinery account in this case, that increases. So only if it is a machinery or land or building. But if it's a stock account, let's not have an inventory account. Let us affect the purchases or sales account, right? So at this stage, I would like to ask you one question. Why is the balance sheet always tallying? So why at the end of every transaction, why is that the balance sheet is always tallying? 1 lakh, 1 lakh, 2 lakh, 2 lakh, or 50,000, 50,000. Why is that is always tallying? Okay, we discussed this earlier. That a transaction will affect two heads, the liability and the asset head, by the same amount. So 1 lakh, 1 lakh. Or as in the case of that, we have the example, the very first example, where machinery is bought for cash. So both heads in the same asset column. So cash is decreasing and machinery has increased. So two heads are affected in the same column, but even then one is increased, one is decreased. So that's where the balance sheet is telling. So my question is, why is it happening like this? I mean, we are having cases where the same amount is increasing on both sides. That's why balance sheet is telling. Or on the same side, one is increasing, one is decreasing, and hence the balance sheet is telling. But my question is, why is it happening like that? So why can't we have a case where cash increases and machinery increases? So earlier the total of the balance sheet was 1 lakh, 1 lakh. Now cash increased by 25,000. Machinery goes up by 25,000, and this becomes 1.5 lakhs. This remains 1 lakh. Why can't we have a situation like that? Why is it always that either on the both sides same amount increasing, or on one head one is increasing, one is decreasing? Can we have a situation? Aren't we lucky to have these situations where both are increasing? Are we just lucky to have these instances where the amount is increasing by the same side on both liabilities and assets, or one increase, one decrease in the same head? Is it just a matter of luck? What if we are unlucky and something like this happens? Both are increasing. Okay, we will never have a situation. We'll never have a situation where amount is different. One is 1 lakh, 1.5 lakh. We can't have it because a transaction is for a particular amount. Purchase stock for cash, 1 lakh. Two heads are affected. Whatever the two heads are, the amount is same. So we won't have a difference in the amount side. One side 1 lakh, 1.15, another side 1.5 lakh. We don't have the situation. So from the point of view of amount, you will always have the tallying going on. But what if there's a situation where on one side one amount increasing, another head is also increasing? What do you do then? Will it ever happen? Let me say you the beauty of balance sheet is, the beauty of the double entry bookkeeping is, it will never happen. It will never happen. And the reason why it doesn't happen, I earlier told you that there is some magic going on, and this is not a magic that has come from up above heaven. Nobody in heaven has dropped this magic to us. This is by design. The double entry bookkeeping by design, it is designed in such a way that the case where we discussed, the unlucky case which we discussed, it's never going to happen. You'll always have situations where both liability and assets are affected in the same way, hence balance sheet tallies. Or there will be a situation where the same head increases and the head decreases on the liability side, or on the asset side one increases, one decreases. But you'll never have a situation where both will increase in the same head. That is how it is designed. Now we need not go into depth into why that is happening, right? We not go into depth because I promise you there is not going to be a book on accounting, and I won't burden you with unnecessary details. But if you're curious to know about it, I mean, you need to refer to any standard book on accounting. But briefly, if you want a brief idea as to why that is happening, there are four items which you need to remember: debit, credit. So in a business transaction, you have these four items. Either it will be an income expense, any transaction. It will either affect the income expense or a liability, asset and head. So these are the four heads that any transaction will affect. We spoke of every transaction affecting two heads. Either it will be a liability, asset or income and expense. We are now defining two terms: debit and credit. So what we are saying is the double entry bookkeeping is designed in such a way that we will debit all expenses and all assets, and what we'll do, we will credit all income and all liabilities. This is by design, right? Please remember that this is by design. We have designed the double entry bookkeeping to be such a way that we debit all expenses and all debit all assets, and we credit all liabilities and credit all income. Please note that this might be confusing, but you need not get into the depth of it. But I told you, if you are curious to know why this is happening, this is the basics, right? If you want to go into depth, you need to refer any standard book on textbook. This is what the summary looks like, right? So we'll be debiting all expenses and assets, and we'll be crediting all income and liabilities. It is this opposing nature that ultimately results in balance sheet telling, right? This is as far as I want to go. Don't want to go into depth. We'll stop here. This is as far as we'll go in this segment, and in the next segment 2.4 we'll discuss another important concept, matching principle. This particular video 2.3 on dual aspect has been very lengthy, more than 1 hour. Thank you for your patience, but please know that this is a very important concept in accounting. I don't think so you'll be applying it in your day-to-day life. You'll be given a prepared balance sheet. When you are in a bank job, a company gives its balance sheet, it's already prepared. You're not going to how it's prepared, what are the heads that are affected, what is the trail balance, what is the ledger, journal. You need not be affected all. You need not be related. But then for your knowledge, it's always nice to have what is the back end, what is happening in the background, And this video, I know it's a lengthy video, it's more than 1 hour, but it must have served the purpose of giving you a nice idea as to how transactions are entered in the books of account. That is the double entry bookkeeping. So in the next segment we'll be discussing about matching principle. See you then.